Welcome to today's What Moved the Market show. I'm your host Prem. It's Monday, February 9, 2026, and here is everything you need to know as the markets close for today. Indian equities extended last week's rebound with a strong broad-based session. The Sensex finished just above 84,065, gaining roughly 485 points, or about 0.58%, while the Nifty 50 settled near 25,867, up around 174 points, or 0.68%. Bank Nifty once again outperformed, closing in the vicinity of 60,669, higher by about 550 points, close to 0.91%, and crucially holding well above the psychologically important 60,000 mark throughout the day. The mood on the street was firmly risk-on. Optimism around the interim India-United States trade framework, which lowers average tariffs on several Indian exports, combined with the return of foreign portfolio investors as net buyers in early February, kept dip buyers active in banks, metals, and domestically focused cyclicals. Broader markets beat the benchmarks comfortably, with the Nifty mid-cap index up roughly 1.5%, and the small-cap gauge climbing more than 2.5%, while virtually all the major sectoral indices ended in the green, even though pockets like information technology and pharma lagged the headline move as traders booked profits in defensives and global-facing names. On the currency front, the rupee inched higher. The dollar-rupee pair was quoted around 90.6 in the spot market, its strongest zone in over 3 weeks, helped by stable domestic rates after the Reserve Bank of India's policy hold, and by the improved sentiment following the interim trade understanding with the United States. That mild appreciation, still not far from the recent record week levels just above 92 to the dollar, eased some concerns on imported inflation and oil, and provided an additional tailwind to rate-sensitive areas of the market, even if exporters and large information technology stocks stayed a bit cautious about the medium-term impact of a firmer currency. Stock-specific action today was dominated by banks, metals, and select consumption stories. State Bank of India was the undisputed star, surging in the region of 7 to 8% to a fresh lifetime high after delivering blockbuster third-quarter numbers and upgrading its credit growth guidance. Strong loan growth, stable margins, and benign credit costs impressed the street, and that single name contributed meaningfully to the gains in both Nifty and Bank Nifty, as the Nifty PSU Bank index itself vaulted to a new peak. Alongside SBI, Shriram Finance, Tata Steel, Hindalco, Tata Motors, Passenger Vehicles Arm, Bharat Electronics, and Grasim stood out among the bigger Nifty gainers, riding on a mix of solid earnings, trade deal tailwinds for metal exporters, and risk appetite returning to quality lenders and industrials. On the losing side, the list was short but featured prominent defensives. Names like Max Healthcare, Power Grid, ITC, ICICI Bank, and Nestle India saw profit-taking after their earlier runs, underperforming a largely one-way tape as money rotated out of low-beta defensives and into cyclicals and public sector banks. The declines were not deep in absolute terms, but they did highlight that leadership has clearly shifted back toward pro-growth sectors for now. Outside the benchmark indices, the action in mid and small caps remained lively. Kalyan Jewellers spiked close to 10 to 15% intraday, after posting roughly 90% year-on-year growth in third-quarter profit and boosting investor confidence further by filing a complaint with SEBI over alleged manipulative trading in its stock. That combination of strong earnings and visible corporate action against suspected malpractice drew in heavy volumes and made the stock one of the day's standout movers in the broader market. Atul Auto also stayed in focus, building on nearly doubling profits and healthy revenue growth reported recently, which kept interest high in select auto and capital goods mid-caps. The primary market was busy as well, with two high-profile mainboard issues opening their books today. Fractal Analytics, the artificial intelligence and analytics firm, launched its roughly 2,834 crore rupee IPO, and as of the latest available data, the issue was only around 4% subscribed overall on day one, though the retail book had a better take-up, and the company had already garnered over 1,240 crore rupees from anchor investors ahead of the offer. iFinance, the MSME-focused non-bank lender, also opened its 1,000 crore rupee issue, but subscription here was even more measured, with total bids running at roughly 0.13 times by late afternoon, led primarily by retail and a small portion of qualified institutional demand. The read-through from both deals is that even in a buoyant secondary market, primary investors are being selective on valuation and business quality. From a levels perspective, today was an important day for index watchers. Nifty spent the session consolidating above the earlier resistance band around 25,800, briefly pushing toward an intraday high close to 25,920, before settling comfortably above that old ceiling. Intraday dips toward the 25,800 zone were bought, effectively turning that area into a near-term support. Below that, the broader support cluster that many technicians are watching remains in the 25,500 to 25,450 range, and that pocket was not tested today. On the upside, the psychological 26,000 mark and then the 26,200 zone are seen as the next potential hurdles if the current momentum extends. Bank Nifty delivered an even cleaner breakout. The index gapped up well above 60,000, convincingly took out its previous record highs around 60,400, and then made a dash toward the upper resistance area near 60,880 before closing only marginally off those highs. For traders, immediate support now rises to the 60,400 to 60,300 band, essentially the gap and breakout zone, while deeper demand is expected between 59,800 and 59,500 if there is any sharp intraday shakeout. On the resistance side, the near-term roadmap now points towards 61,000, and if that is conquered, the 61,400 to 61,700 corridor as incremental targets. Sector-wise, leadership was unmistakable. Public sector banks rode, with the Nifty PSU Bank index jumping roughly 3.5% to 4% to a fresh record top, powered not just by SBI, but also by follow-through strength in names like Bank of India, Indian Bank, and several other lenders that have been reporting record profitability and improving asset quality. Realty, media, consumer durables and metals indices also logged gains in the 2 to 4% range, reflecting the market's preference for domestic growth, rate stability, and beneficiaries of the trade deal narrative. In contrast, information technology and pharma remained relative laggards, still grappling with global tech volatility and margin questions, though they did not materially drag the frontline indices today. On the macro and regulatory side, the market is still digesting last week's Reserve Bank of India policy decision. The Monetary Policy Committee kept the repo rate unchanged at 5.25% with a neutral stance, but nudged its inflation projections higher for the later part of fiscal 26 and early fiscal 27. Even as it reaffirmed a robust real growth forecast of around 7.4% for the current financial year. That combination of solid growth and carefully managed but slightly firmer inflation trajectory has reinforced expectations that policy rates are likely to stay on hold for an extended period, which supports banks and domestic cyclicals but keeps a lid on hopes for very aggressive rate cuts. SEBI meanwhile continues to refine the market's plumbing in ways that are subtle on a single day but important over time. Recent circulars have overhauled the framework for dealing with technical glitches in large brokers, electronic trading systems, and consolidated rules for registrars and share transfer agents into a single master circular, while other regulations have restructured disclosure and governance norms for high-value debt-listed entities. At the same time, consultation papers on the index derivatives framework and on stress tests and settlement guarantee requirements for commodity clearing corporations, as well as earlier changes to derivative contract selection, margins, contract sizes and weekly expiries, all point to a clear direction of travel, curbing excessive retail speculation in futures and options, aligning derivatives more closely with the underlying cash market, and making risk management more proportionate to actual exposures. These are not intraday headline drivers, but they are already reshaping how aggressive F&O traders think about leverage expiries and product selection. Commodities added another important dimension to today's market narrative. Globally, crude oil prices edged lower as tensions in the Middle East eased, and talks between the United States and Iran in Oman were described as a step forward, reducing the immediate risk of supply disruption. Brent crude hovered just below the high $60 per barrel area, after having lost roughly 4% last week, a dynamic that is marginally positive for India's import bill and for fuel-intensive sectors such as paint makers, aviation, and select chemicals, even as traders remain alert to any renewed flare-up in the region. On the domestic bullion front, the rebound was much sharper. On the multi-commodity exchange, active gold futures were trading around 1,56,000 to 1,58,000 rupees per 10 grams, staging a strong comeback after a bruising decline of more than 10% over the past 10 days. The bounce has been driven by a mix of safe haven buying as global geopolitical and tariff risks stay elevated, a softer dollar, and bargain hunting after the recent slide. Silver futures for March delivery surged close to 5%, settling near 2,62,093 rupees per kilogram, while city-wide spot prices in many parts of India hovered around 2,84,900 rupees per kilogram, underlining just how volatile the white metal has been so far this month. Geopolitically, two themes were front and center for equity traders today. The first is the interim India-United States trade framework itself, which, according to official and media reports, trims average tariffs on several Indian goods to roughly 18% from about 25% and eases some curbs around energy flows. That deal has been a clear support for exporters in metals, manufacturing and jewelry, and has boosted confidence in India's external positioning and in the rupee, encouraging foreign investors to re-engage with the market. The second is the broader backdrop of renewed tariff rhetoric and geopolitical unpredictability out of Washington and elsewhere, which has kept global volatility measures elevated even as some specific risks, such as immediate Middle East supply shocks, appear to be receding for now. Together with an important week for United States economic data, that mix explains why Indian markets are buoyant but still paying close attention to global cues. Turning to the road ahead, the technical picture for tomorrow's session remains constructive, but calls for a bit more selectivity. For the Nifty 50, the key near-term reference zone on the downside is now the 25,800 to 25,780 area. As long as intraday dips respect that band, traders will be watching for a potential extension of the move toward the psychological 26,000 mark, and beyond that, follow through into the 26,200 zone. A convincing break and close back below roughly 25,500, however, would signal that the breakout has failed in the short term and could trigger a deeper retracement toward 25,450 and even the 25,300 pocket, particularly if global markets wobble or if profit-taking accelerates after the recent run. For Bank Nifty, the bias is even more strongly upward after today's breakout above prior record highs. If the index can hold the 60,400 to 60,300 support band on any early dip, technicians see room for a continuation of the move toward 61,000. And then into the 61,400 to 61,700 corridor in the near term. A sustained slip back below about 59,800, on the other hand, would raise the risk that today's move was a short-lived blow-off, potentially inviting profit, taking back toward 59,500, and forcing traders to reassess the strength of the breakout. Putting that all together into one actionable takeaway, the message from today's tape is that leadership has clearly coalesced around PSU banks and metals against a backdrop of improving foreign flows, a supportive trade narrative and stable domestic rates, but with indices near the top of their recent ranges, fresh longs are best built on controlled dips into well-defined support rather than chased at opening gaps. If Nifty were to retest and hold the 25,800 area tomorrow, while Bank Nifty stays comfortably above around 60,400 in crude and the rupee remain benign, staggered buying into quality large-cap banks and leading metal names with tight stops just below those support zones offers a more favorable risk-reward than aggressive momentum buying after large intraday spikes. That's a wrap on today's What Moved the Market show. If you want specific stocks or sectors covered, or have questions on any of the levels and themes discussed, send them in so they can be taken up in upcoming episodes. Stay tuned for tomorrow morning's wrap and send in your questions.